Hi guys, so welcome to the fundamental macro analysis. So basically, I'm also going to be uploading the PDF version onto Google Drive so you can go over it in your own time. So it's basically going to be a bit more in-depth fundamental analysis, and also I'm going to go over the COT reports so you can know what it is and then also how to use it as an edge in your trading, especially if you're going to be swing trading. So fundamentals is basically, as you know, the underlying economic variables that impact the demand or supply of a currency. This can also be socio-economic factors as well. So basically, a higher demand for a currency will appreciate the currency, so it will gain strength. A lower demand will obviously depreciate the currency, where it will obviously weaken. We also have to assume ceteris paribus in economics, which means all other things being equal. So basically, you have to assume the data you're looking at, the specific variable, you have to assume that other things in the economy and within the country are going to be constant, okay, at that time. Because obviously there's lots of different moving things happening simultaneously in the country, okay. So we're looking at the GDP, we can you only focus on that figure for that time being. So the most important variables or fundamentals in forex trading will be the CPI, the interest rate, GDP, NFP, retail sales, and the trade balance. Obviously, each different variable has a chain of events. So we simple it down a bit and look at the data itself. So that's why I'm going to remind you again, ceteris paribus, where you only focus on that specific data, okay, the specific variable. So, so the most important factor influencing the currency is obviously going to be the interest rates, okay. Basically, a lower interest rate means a weaker currency. A higher interest rate means a stronger currency. Okay, so when the interest rate goes up, there's obviously going to be more demand for the currency as a foreign investment. So foreign investment or capital inflows will increase into the currency as the demand for the currency itself will increase. So here's an example in 2016. Okay, on the left you'll see the interest rate went up, okay, and then on the right you can see USD. Okay, so obviously USD is the quote currency, and you can see that when the interest rate went up here in 2016, look at the chart, you can see that USD, the dollar, strengthened as the chart's going down. Okay, so basically what COT reports are is commitment of traders report, okay, but you have to keep in mind that any indicator, economic indicator or technical indicator, okay, they are almost always lagging, okay. So the data you're looking at is always going to be based on the previous week or the previous month or the previous quarter, okay. So COT reports are going to be lagging for a week, but it still gives you an image on, I'm going to refer to it as BFIs. I'm not going to keep saying big financial institutions, okay. So it gives you a view, or like an inside view or a hint on what are the BFIs doing at this point, okay. So it shows you what they're doing and also where this institutional order flow is heading into or out of. Okay, so over here is the 16th of March 2016. Okay, so this is when the interest rates started going up for the United States dollar. Okay. Over here, we can see on the 29th of March, the long positions on the dollar is 37,537. Short positions are only 19,000. Okay. And when this interest rate increased, you can see that the dollar had more long positions on the BFIs, less short, and there was also more longs added. The figures are similar to that specific week. 1776 was added, and also 17 shorts were added, but there was still more longs added, and the net positions of the long was obviously 37,000, so way more than 19,000. COT reports are released on a weekly basis, so it's reported on Tuesdays. The data gets released every week, Friday, just before market close. So it's always important also to just keep in mind the change, okay, over here. Okay, so this is the normal fundamentals that you always look at, which is in the other video as well. Basically, on FX Street or those websites, you'll see for the week upcoming the macro fundamental release dates for the news. Obviously, the bigger the difference between the consensus and the actual data, it's going to be more volatile. So depending on what they expect is going to happen and what actually happens, and also the previous data. So the bigger the difference, the more volatile it will be. And also these economic data, the releases will obviously set the fundamental or the market bias for the movement upcoming. So if the GDP increases, that obviously will show you that the demand for the currency will increase as well. As the currency is getting stronger, the economy is doing good. Okay? But also remember that it is lagging. So the GDP for, let's say, Q1 is giving you an indication of the health of the economy, but it is based on the previous quarter or the previous 4 months. So if it's doing good, GDP for the previous 4 months, you could expect it to keep going and increasing for the next few months, okay? Or the next month at least, so you can also get in on that buy or sell if it was negative. So basically the interest rates do stay constant for longer. If you look at now 2020, when the US dropped the interest rate, it's still the same. They haven't increased it yet. So GDP is the gross domestic product. It tells us how much the consumers are spending within the country. This also includes investment spending, government spending, and then the net exports. So exports minus imports. And it's released quarterly, and then obviously yearly and at monthly at times as well, depending what you're looking at. The CPI is basically the inflation. Okay, you get consumer price index and you get purchase price index. And the PPI can be used to forecast the CPI. So as producers pay for the raw materials used in production, this increase in PPI will become the burden of the consumers, because they're going to increase that price, to the consumers, the actual company producing product X, Y, or Z. And obviously, a rise in the price of a basket of goods shows you there's inflation. And this obviously weakens the demand for the currency if the inflation is going to go up. So the CPI keeps going higher, or there's expectations of a higher CPI or higher inflation that's going to decrease the demand for the currency. And we are seeing that currently with the dollar. Okay. The employment just shows you the social economic health of a country. This is going to be the average hourly earnings, the unemployment, and the NFP. The NFP, you are familiar with that. That's released every first Friday of every month. So obviously, the lower the unemployment, the healthier the economy is doing, or the socio-economic health of the country. It means more people have money to spend, and that obviously logically it's going to obviously increase GDP. If there's more consumers who have jobs who are able to go and buy something, the GDP will most probably increase. Okay? Because more people having money, there's more money supply, there's more this movement in the total economy. Retail sales will show you basically how the sales are going for retail stores. Okay? So it will tell us that the consumers are being confident, they are actually spending money. If people are spending money, it means they have an income, they have a job, they are feeling confident in the economy. And yeah, so this basically will help you forecast the GDP. Because if someone's spending money, that means the GDP will probably be increasing for the next GDP release, or there will be an increase in GDP for the next month. So there is some form where all the economic variables are actually interlinked. When I mention that it's actually there's a chain of events where each thing impacts the other variable. So central bank meetings are obviously extremely important, as it is linked to the interest rates or inflation. So when these people or the central banks have meetings, you'll always experience big volatility in the market. And obviously, it's publicized a lot, so you can obviously go and read up about it on the key points of that meeting, to see if there is inflation concerns, how might they or are they thinking about decreasing or increasing the interest rate. Okay. A high CPI data release could result in the Fed increasing the interest rate to control the rise in inflation, as people will start spending less money. So the dollar right now, there is some fears of inflation because of the low interest rate, so they might increase the interest rate maybe later this year, and hopefully the dollar will probably start strengthening again, for those who obviously withdraw in the USD, because right now the dollar is weak. So basically, government bond yields and the relationship with currencies. So that if you see the 10-year bond yield is rising, the demand for the dollar will rise as well. This is basically means if you have an investment into the 10-year bonds and the yields are rising, you'll be making more money. This will also obviously increase foreign investment or capital inflow into the country. More money coming into the economy, or more USDs being demanded for, because the yields increasing. So your return on investment projected for the 10-year is increasing. So if the yields go up, the demand goes up. If the yields go down, the demand goes down. And this was obviously for every other currency and the specific countries' government bond yields. There's a few correlations to keep in mind. The price of gold and US dollar has a negative correlation. The price of oil and Canadian dollar has a positive correlation because they export oil. The price of oil and Japanese yen, negative correlation. Australian dollar has a positive correlation with the price of gold. Or USD has a 80% correlation with gold, meaning that the relationship will usually hold during uncertain economic climates. So the charts will move similar, about 80% of the time. And then safe haven currencies strengthen in its value in uncertain economic climates or geopolitical stress like COVID. But the US dollars didn't increase, but usually it is USD, the dollars, Japanese yen, and Swiss franc. Where we saw last year with the interest rates being dropped in the US, obviously gold increased because it's negative correlation to US dollars. So I do post these images in the fundamental group. So you can, it's basically the same thing where it says that the date, it shows exactly how the movement is going, the net positions. Over here we can see